Here are today's top 5 macro stories. Iran just lost its biggest trading partner, and on Monday, the United States Treasury names the price for anyone who takes its place. The United Arab Emirates was Iran's biggest trading partner. As of Wednesday, it is not trading with Iran at all. Every trade and every financial transaction suspended. The trigger was the 13th of August, when 2 tankers owned by Abu Dhabi's national oil company were attacked, and then reported missile fire at Emirati shipping. Iran denies both. Here is why this is bigger than another sanctions headline. For 20 years, Dubai was the hole in the wall. Exchange houses turned Iranian money into usable money. Re-export traders moved the goods Western sanctions said Iran could not buy. One regional analyst told the AP this could prove more effective than American and European sanctions combined. That is one view, but the plumbing supports it. Then came Washington. Thursday, Treasury Secretary Scott Bessent. If you insist on doing business with Iran, transferring money, buying their oil, doing ship-to-ship transfers, the United States Treasury will put its full might and force toward enforcing against you. The specifics arrive Monday. The reported toolkit: curbs on Gulf exchange houses, North Korea-style secondary sanctions, confiscation of Iranian assets abroad rather than freezing them, and pressure on China's independent refiners, the so-called teapots, which take most of Iran's crude. The timeline: August 13th, the tankers. August 17th, the June interim deal between Washington and Tehran lapsed with no talks scheduled. Wednesday, the Emirati cutoff took effect. Thursday, Bessent's warning. Monday, the plan. The strait is already a fraction of itself, 73 transits last week against 91 the week before, and supertanker rates from the Gulf to China above $520,000 a day. Now the power lens. The dollar system is the weapon, and China is the one counterparty Washington cannot hit cleanly. So far, Treasury has only warned 2 large Chinese banks, with a Trump-Xi meeting ahead. Who gains? Gulf and American producers at $86 to $93 oil, and ship owners. Who pays? Iranian importers, Dubai's traders, and every consumer downstream of a narrower strait. Iran's foreign minister called it doubling down on failed policy. Iran is being cut off from both sides of the Gulf at once. Monday we learn whether the second side has teeth or just a press release. 2. The bond market beat the Treasury in a day. Wednesday's doubled buybacks dropped the 30-year yield from 5.34%, its highest since 2007, to 5.18. By Thursday, it was back at 5.25, the rally gone. So the Treasury Secretary went on television. Buybacks could be more than $4 billion per issue, he said. Yields do not reflect fundamentals, he said. And a fiscal consolidation plan with the budget director is coming within days. The market asked for a budget. It was just promised one. 3. The deadline became a pause, and the pause became another pause. 50% tariffs on Canada were held again overnight with the deal still unsigned. Reported terms: autos to 15%, dairy access, no softwood relief, remain a draft. A deadline only one side can move is not a deadline. It is leverage. 4. Growth is not the problem. The Philadelphia Fed's manufacturing index printed 47.4 against 25 expected, nearly double. Jobless claims fell to 206,000. Input costs in the July surveys ran the hottest since late 2022. Strong data closes the easy path to lower yields. It undercuts the White House's case for cuts and hands the Fed's hawks their numbers, which is exactly why the Treasury is buying bonds instead of waiting for the Fed to. 5. Gasoline rationing has spread to nearly every Russian region, Reuters reports, after Ukrainian strikes on top 5 refineries. Moscow admitted the shortages on August 14th. Western sanctions took years to dent Russian fuel revenue. Drones did it to Russian pumps in one summer. Traders now cite it as the second bid under Brent at $93, alongside Hormuz. Who pays? Russian motorists, the Russian budget, and at the margin, every oil importer. Iran lost its banker, the bond market beat the Treasury in a day, and Monday, the dollar goes to war with Iran's buyers. That is macro today. Here is today's question for you. A Gulf monarchy just did more to isolate Iran in 1 week than 2 decades of Western sanctions, for its own reasons on its own timeline. And the American plan arrives Monday aimed mostly at Chinese refiners. Washington has, so far, only warned. So who actually enforces the rules of money now? The country that prints the dollar, or whoever controls the nearest port? Tell me in the comments. Not the slogan, the reasoning. I read them. Blue pill, this is the system working. The Emirates closed the leak, Treasury is sequencing pressure to avoid a China rupture, and $93 oil is the price of a strait that still moves 73 ships a week. Red pill. Sanctions that depend on a neighbor's grievance are not a policy. They are a coincidence. The day Abu Dhabi's interests shift, the leak reopens, and Monday's plan only works if Washington is willing to sanction Beijing. Watch whether it is. The timeline keeps moving. We will see you in the next one.